Most people hold dollars every day without ever asking what a dollar actually is. That is the first problem. They ask whether the market is going up. They ask whether inflation is coming down. They ask whether stocks are expensive. They ask whether the Federal Reserve will cut rates. They ask whether gold or silver is in a bubble. But they rarely ask the deeper question, what is the thing I am measuring all of this in? A dollar used to have a definition, not a slogan, not a nickname, not an opinion from a central banker, a legal definition. In 1792, the United States defined $1 as 371 grains of pure silver. That was not metaphorical. A dollar was a weight of silver. So the question is simple. If the definition changed, what is a dollar now? That is not an academic question. It is not a history trivia question. It is not a debate for people who collect old coins. It is a question about your savings, your retirement, your purchasing power, and the system you live inside. Because if the money you use every day no longer has the same foundation it once had, then you need to understand what replaced that foundation. And when you study that history, silver becomes much more important than most people think. Silver is not just a shiny metal. Silver is a way to understand money itself. For thousands of years, people used silver because it had the qualities that money needed. It was scarce enough to hold value, but abundant enough to be used in ordinary transactions. Gold was too scarce for daily commerce. You could not easily buy bread, grain, tools, or small goods with a large piece of gold. Silver was practical. Silver was the people's money. It was used as currency for more than 5,000 years. Ancient civilizations were using silver as money long before modern governments, central banks, paper currencies, or digital bank balances existed. Silver predates the modern financial system by thousands of years. That should tell you something. A monetary system can be changed by law. But human beings keep returning to certain forms of money because those forms solve real problems. Silver solved a problem. It was divisible, it was measurable, it was scarce, it could not be printed, it could be weighed, it could be melted, it could cross borders. It did not require you to trust a politician's promise. That is why silver became embedded in civilization. The Spanish silver dollar, often called the piece of eight, became one of the most important currencies in the world. It circulated for centuries, it was trusted across continents, it was legal tender in the United States for a long period. The name dollar itself is connected to this history. That is important because modern people think global reserve currencies are always based on government power, central banks, and financial institutions. Historically, the most trusted money was often trusted because it was metal, it had weight, it had substance, it had a measurable standard. When the United States created its monetary system, this was understood. Alexander Hamilton helped design a bimetallic system using both gold and silver. Gold and silver were legal tender, valued at a fixed ratio. The reason was practical. Gold alone was too scarce to support the everyday needs of a growing economy. Silver gave the system a broader base. The founders did not define the dollar as whatever a committee later decided. They defined it as a specific weight of silver. That matters because it tells us what money once meant. Money was not supposed to be infinitely elastic. Money was not supposed to be whatever the government needed it to be during a budget problem. Money was not supposed to be a promise floating in the air. It was tied to something scarce and measurable. That kind of system imposes discipline. If the government wants more money under a metal standard, it cannot simply create it by political decision. It needs more metal. That is inconvenient for governments. But that inconvenience is exactly what gives savers some protection. A monetary system without discipline becomes easier to abuse. That is one of the most important principles in economic history. If money can be created easily, it will eventually be created easily. Not because every policymaker is evil, because incentives push in that direction. Governments want to spend. Voters want benefits. Wars require funding. Crises require support. Banks want liquidity. Markets want bailouts. Politicians want to avoid pain today, even if it creates a bigger problem tomorrow. A hard money system resists that. A fiat system permits it. That is why the history of silver matters. The first major break came in 1873. Congress passed the Coinage Act of 1873. And the silver dollar was removed from legal tender status. America moved toward a gold-only standard. To many people, it sounded technical. But technical monetary changes can produce enormous social consequences. The result was painful. The money supply tightened. America entered a long period of falling prices and economic stress. Farmers were especially damaged. They borrowed money to buy seed, equipment, and land, then saw the prices of their crops fall. Debt became heavier in real terms. Wages fell, unemployment rose. Ordinary people felt the squeeze. This is why many people at the time called it the crime of 1873. They were not using that phrase casually. They believed silver had been pushed out of the monetary system in a way that benefited financial elites and hurt workers, farmers, miners, and ordinary people who depended on a broader money base. Whether one agrees with every political argument from that period is not the point. The point is that changing the definition of money changes the distribution of power. When silver was demonetized, the system shifted. Those who had access to capital benefited. Those who needed a more flexible money supply were crushed. This is why money is never neutral. The rules of money determine who gains, who loses, who can borrow, who can repay, who controls credit, and who carries the cost of deflation or inflation. Then came the final break in 1971. President Nixon ended the dollar's convertibility into gold. After that, the dollar was not directly backed by silver or gold. It became money backed by trust law, military power, taxation, financial markets, and the belief that others would continue accepting it. That is fiat money. Fiat money can work for a long time, but it depends on trust. And trust is not the same thing as scarcity. Trust can be stretched. Trust can be abused. Trust can be weakened slowly, year after year, until the people using the currency realize that the number on the bill stayed the same, but the value behind it did not. That is what happens when purchasing power declines. The dollar did not disappear after 1971. It became the center of the global financial system. But it also became something very different from the dollar, originally defined in 1792. It was no longer a fixed weight of silver. It was no longer redeemable in gold. It became a promise. And promises are only as strong as the system behind them. This is why I say that if you do not understand silver, you do not understand money. Silver shows you the before and after. Before, money was weight. After, money became trust. Before, money was constrained by metal. After, money was constrained mainly by policy, credibility, and public tolerance. Before, the dollar had a physical definition. After, the dollar became a flexible unit inside a fiat system. That shift is the foundation of the world most people now accept as normal. But normal does not mean permanent. Now, the story of silver would already matter if it were only monetary. But today, silver has something gold does not have. At the same scale, silver has a dual identity. It is still a precious metal. People still buy it as a store of value, as a hedge against currency debasement, as a form of financial insurance. But it is also an industrial metal that makes silver very different from gold. Gold is mostly held, stored, and hoarded. Central banks buy it. Investors own it. Jewelry consumes some of it, but most gold ever mined still exists in some recoverable form. Silver is different. Silver is used. Silver is consumed. Silver disappears into billions of products in tiny amounts that are often uneconomic to recover. That is the key difference. Today, roughly 60% of silver demand is industrial. Gold's industrial demand is much smaller. That means silver is not simply poor man's gold. It is not a lesser version of gold. It is a different asset with a different demand structure. Gold is primarily monetary insurance. Silver is monetary insurance plus industrial leverage. That is why the setup is so interesting. Silver has the properties industries need. It is the most electrically conductive metal on Earth. It is more conductive than copper. It is more conductive than gold. It is the most thermally conductive metal. It is extremely reflective. Those properties make it difficult to replace in many applications. If you are building electronics, chips, solar panels, electric vehicles, sensors, advanced communications, or high-efficiency systems, performance matters. You cannot always substitute a cheaper metal without losing efficiency, reliability, or functionality. Technology wants performance. Silver provides performance. That is why silver sits inside the technologies that define the future. Solar panels are one of the biggest examples. Every solar panel uses silver for conductivity. The industry has worked hard to reduce the amount of silver per Pascal Nel because silver is expensive. The source notes that silver content per Pascal Nel has been reduced significantly over the last decade. But that does not mean demand disappears because global solar installations are expanding rapidly. Governments are mandating clean energy buildouts. Utilities are adding solar capacity. Countries are trying to reduce carbon emissions. Solar capacity is expected to grow dramatically by 2030. So even if each panel uses less silver, the number of panels can grow so much that total silver demand still rises. And the most advanced high-efficiency solar technologies may use more silver, not less. That is the important point. Efficiency often requires better materials. Better materials often lead back to silver. Then there are electric vehicles. An electric vehicle uses about twice as much silver as a traditional gasoline vehicle in the source framework. More electrical contacts, more sensors, more battery systems, more power inverters, more electronics, more connections. Every switch, sensor, and connection can require silver. If electric vehicles become a larger share of global auto sales, silver demand rises with that trend. You do not have to love electric vehicles to understand the demand chain. Policy, technology, and consumer adoption can still move the system. Then there is artificial intelligence. AI data centers require enormous computing power. That computing power creates heat. Managing heat is essential because advanced chips are expensive and fragile. Silver's thermal properties make it useful in systems where heat transfer and reliability matter. AI is not only software. AI is physical infrastructure, data centers, chips, power systems, cooling systems, transmission systems. All of that requires materials. Silver is part of that material system. Then there is 5G and semiconductors. High-speed communication requires advanced circuitry and antennas. As speed, power, and efficiency requirements increase, the quality of materials matters more. Silver content in certain applications can rise because performance requirements rise. This is the hidden part of the digital world. People think digital means weightless. It is not weightless. The digital world is built on physical materials, chips, wires, servers, antennas, batteries, solar panels, copper, lithium, rare earths, silver. The future is not floating in the cloud. It is sitting in mines, refineries, supply chains, and electrical systems. That is why silver matters. Now, here is the most important industrial point. Gold is hoarded. Silver is consumed. Almost every ounce of gold ever mined still exists somewhere. It may be in vaults, jewelry, central banks, coins, bars, or private holdings, but it is generally recoverable. Silver often is not. Silver is used in tiny amounts spread across phones, laptops, cars, solar panels, medical devices, electronics, and industrial systems. Once it is embedded in small quantities across billions of products, recovering it can cost more than the silver is worth. That means much of the silver used by industry is effectively gone from the investable supply. Every phone you owned, every solar panel on a roof, every electric vehicle on the road, every data center expansion, every high-performance device, they all draw from the silver supply, and much of that silver does not come back. This is why silver's industrial demand is so powerful. It is not just being borrowed by industry, it is being consumed by industry. Now, if demand is growing, the next question is supply. Can miners simply produce more silver? This is where the story becomes even more important. For 6 consecutive years, the world has consumed more silver than miners have produced. The source points to deficits from 2021 through 2026, with 2026 projected to be another deficit year. The cumulative shortfall is close to 1 billion ounces in that framework. 1 billion ounces. That is not a small mismatch. When annual demand exceeds mining supply, the shortfall has to come from somewhere. It comes from above. Ground stocks, warehouses, exchange inventories, ETF holdings, and other stockpiles. In plain language, the market has been eating the stored silver that can continue for a while, but not forever. A stockpile is a buffer. It is not permanent supply. Once inventories decline far enough, the market becomes tighter, price becomes more sensitive, a shortage becomes harder to hide. This is exactly the kind of structural setup that matters: persistent deficits, growing industrial demand. Limited new mining supply, declining inventories, monetary demand as people worry about fiat currency. That combination is rare. Now, why can miners just produce more silver when prices rise? Because silver supply is relatively inelastic. That is the economic word. It means supply does not respond quickly to price. One reason is that much of the world's silver is produced as a byproduct of mining other metals. It often comes from lead, zinc, copper, and gold mines. In many operations, silver is not the main product. It is the side product. That means silver production decisions are often driven by the economics of other metals. If copper mining is profitable, silver may come out as a byproduct. If zinc or lead production slows, silver supply may slow too, even if silver rises dramatically. A mine built primarily for copper does not necessarily increase production just because silver is higher. The economics are tied to the main metal that makes silver supply structurally constrained. Then there is the timeline problem. Building a new mine can take 10 to 15 years exploration, permitting environmental review, financing, construction, infrastructure litigation, community opposition, regulatory hurdles. Even if the world recognizes a silver shortage today, New supply cannot arrive tomorrow. This is one of the most important points in commodity investing. Demand can change quickly, supply often cannot. That mismatch can create large price movements. If solar, EVs, AI, 5G, and semiconductors keep increasing silver demand, but supply cannot respond quickly, the market must rebalance through price, inventory drawdowns, substitution, or demand destruction. That is the system. Now, there is another tool precious metals investors watch: the gold to silver ratio. This ratio measures how many ounces of silver it takes to buy 1 ounce of gold. If gold is $3,000 and silver is $50, the ratio is 60. If gold is $2,000 and silver is $25, the ratio is 80. The ratio helps you understand relative value. Historically, silver and gold move differently. Silver is more volatile. When the ratio is very high, silver is often cheap relative to gold. When the ratio is low, silver has often outperformed and may be relatively expensive compared with gold. In the 20th century, the average was around 47 in the source framework. In more recent decades, the ratio often moved between 50 and 70, though it can spike much higher during extreme periods. In 2020, it moved above 100 and then fell sharply as silver rallied hard. This ratio is not a perfect trading signal, no single number is. But it is useful because it shows whether silver is cheap or expensive relative to gold. When the ratio is around 80 to 100, silver has often been deeply undervalued relative to gold. When the ratio falls below 60, silver may already be outperforming strongly. At around 60, the ratio may be closer to recent average levels. The key is to use it as part of a system, not as a magic answer. A serious investor does not buy silver only because one ratio says so. They look at monetary conditions, industrial demand, inventories, supply deficits, interest rates, the dollar positioning, and risk tolerance. The gold to silver ratio is one lens. It is not the whole eye. Now, I want to be clear about the risks. Silver is not safe in the way a bank deposit feels safe. Silver is volatile. It can move 30%, 40%, or 50%. It can rise violently and fall violently. It can frustrate people for years. It can underperform gold. It can sell off when interest rates rise. It can drop when the dollar strengthens. It can be hit by liquidity stress. It can disappoint people who buy emotionally near a top. If you cannot handle volatility, silver can hurt you. That is not a reason to ignore silver. It is a reason to size it correctly. A good asset can still be a bad investment if the position is too large, the timing is emotional, or the investor cannot tolerate the drawdown. Risk is not only what the asset does. Risk is what the asset does to your behavior. If silver drops 40% and you panic sell, your risk was too high or your understanding was too weak. That is why risk management matters. Silver is not for people who need every dollar safe next year. It is not for emergency funds. It is not for people who cannot sleep through volatility. It is not for people who believe a good thesis means the price must go straight up. It is a long-term monetary and industrial asset with sharp cycles. That is the right way to think about it. Another risk is substitution. If silver becomes very expensive, industries will work harder to use less of it. They already have reduced silver content in solar panels. If silver rises dramatically, the incentive to substitute increases. Copper, nanowires, graphene, and other materials may be explored. So far, substitutes have not matched silver's performance at scale in many applications, but technology can change. This is a real risk. A scarce material creates price pressure. Price pressure creates innovation. Innovation can reduce demand. That is the cycle. If silver goes high enough, engineers will try harder to use less. So the bullish thesis must always watch substitution risk. A third risk is interest rates. Precious metals are sensitive to real interest rates and the dollar. If the Federal Reserve keeps interest rates high, non-yielding metals can struggle. Silver does not pay interest. If cash and bonds offer attractive yields, some investors may prefer those assets. A strong dollar can also pressure silver because silver is priced globally in dollars for foreign buyers. A stronger dollar makes silver more expensive, so silver can be hit by policy. That is important. You can have a strong long-term thesis and still see short-term pressure from the dollar and interest rates. This is why silver requires patience and risk control. Now, let us break down the common myths. The first myth is that silver is just poor man's gold. That is wrong. Silver used to share a monetary role with gold, and it still has monetary characteristics. But today, silver has a much larger industrial demand profile. Gold is mostly monetary and jewelry related. Silver is monetary plus industrial. Gold is insurance. Silver is insurance with industrial leverage. That makes silver more volatile, but also potentially more explosive when both monetary and industrial demand rise at the same time. The second myth is that silver is too volatile to be useful. Volatility is real, but volatility is not the same as permanent loss if the asset is sized properly and held for the right reason. Silver's role is not necessarily day trading. It can be part of long-term wealth preservation, diversification, and protection against currency debasement in inflationary environments. Silver has historically had periods of extraordinary strength. In the 1970s, silver rose dramatically as inflation accelerated. In the 2000s, silver moved from low single digits to nearly $50 during that precious metal cycle. Those moves did not happen smoothly, but they happened because silver can respond powerfully when monetary conditions and supply-demand dynamics align. The third myth is that silver is hard to buy and store. It is not necessarily hard to buy. Physical silver can be purchased from reputable dealers. It can be stored at home, though that creates security risk. It can be stored in insured vaults or third-party storage facilities. Some platforms allow ownership of vaulted physical silver in fractional form. There are also ETFs and mining equities, though those are not the same as physical metal. Each method has trade-offs. Physical silver gives direct ownership but requires storage, security, and spreads. Vaulted silver may offer professional storage but introduces counterparty risk. ETFs provide liquidity and convenience but are financial vehicles, not the same experience as holding metal. Miners offer leverage to silver prices but add company-specific risk, management risk, jurisdiction risk, and cost risk. The right vehicle depends on the investor's objective. Do you want monetary insurance? Do you want trading liquidity? Do you want leverage? Do you want physical possession? Do you want convenience? The answer determines the structure. The fourth myth is that silver is obsolete. That is the opposite of what the demand picture shows. Silver is embedded in solar panels, electric vehicles, AI infrastructure, chips, 5G, electronics, medical devices, and water purification. The modern economy is not moving away from silver. In many ways, it is becoming more dependent on silver. The irony is that people think silver is old because it has a monetary history, but silver is also part of the future. That combination is rare. Ancient monetary metal, modern industrial metal. That is why the setup is so unusual. Now, how should a serious investor think about silver? Not as a get-rich, quick play, not as a guarantee, not as a magic metal that only goes up, not as an all-in bet. Silver should be thought of as a hedge against currency debasement, a diversification asset, and an industrial scarcity play. The dollar loses purchasing power over time by design in a fiat system. Central banks generally target positive inflation. Governments run deficits, money supply expands, debt grows. The purchasing power of cash is eroded gradually. Silver has preserved wealth across long spans of history because it is scarce, useful, and not printable. That does not mean it preserves value every year. It means over long periods it can serve as a hard asset counterweight to fiat money. Now, the rare part today is the collision of two forces: monetary concern. Industrial shortage. Governments are printing and borrowing at levels that would have shocked earlier generations. At the same time, the world is consuming more silver than mines can produce. Solar, EVs, AI, and electronics are increasing demand above. Ground stockpiles are being drawn down. New mine supply cannot respond quickly. This is why the setup matters. If silver were only a monetary metal, the thesis would depend mostly on distrust of currency. If silver were only an industrial metal, the thesis would depend mostly on technology demand, but silver is both. That gives it two engines: currency debasement and industrial demand. When both engines run at the same time, silver can move dramatically. That is the opportunity. But opportunity is not certainty. A good setup can still have painful drawdowns. A strong thesis can still be early. A structural deficit can persist for years before price reacts. The metal can get hit by rising rates or a strong dollar. Investors can lose patience. Speculators can be forced out. That is why you need rules. You need position sizing. You need an understanding of the gold to silver ratio. You need to know whether you are buying physical metal, ETFs, or miners. You need to understand volatility. You need to know why you own it. If you do not know why you own silver, you will not know what to do when it falls, and silver will fall at some point. That is normal. Now, I want to return to the opening question. If the dollar was once defined as silver, and now the dollar is no longer defined by silver or gold, What is a dollar today? A dollar is a unit of account inside a fiat system. It is backed by legal tender laws, taxation, government power, the financial system, the military, global reserve demand, and trust in American institutions. That is powerful. The dollar is not weak simply because it is fiat. The dollar still sits at the center of global finance, but it is no longer a fixed claim on silver. That means its value can be diluted. That means purchasing power can fall. That means savers must think differently. In a hard money system, the money itself carries scarcity. In a fiat system, the saver must often seek scarcity outside the money. That can mean productive assets. It can mean real estate. It can mean businesses. It can mean gold. It can mean silver. It can mean other scarce or productive assets. The principle is simple. Do not hold all your future in something that can be created without limit. That does not mean you avoid dollars. You need dollars, you spend dollars, you pay taxes in dollars, you need liquidity in dollars. Cash is useful, but cash is not a long-term wealth preservation strategy by itself. You need assets that respond differently from fiat money. Silver is one of those assets. It is not the only one, but it is one of the oldest and, because of industrial demand, one of the most interesting. Now, the reason most financial media does not explain this clearly is that the modern system is built around financial assets, not monetary history. People are taught to think in terms of stocks, bonds, savings accounts, mortgage rates, and retirement funds. They are not taught that money used to have a metal definition. They are not taught that demonetizing silver changed economic power. They are not taught that 1971 fundamentally changed the dollar. Without that history, people think inflation is just prices going up. It is deeper than that. Inflation is money losing purchasing power. And when money loses purchasing power, people who only hold money become poorer in real terms. That is why hard assets matter. Now let's think about silver's future in system terms. Demand is rising because the technologies of the future use silver. Supply is constrained because much silver is a byproduct, and mines take years to build. Inventories are being drawn down because deficits persist. Monetary concern is rising because governments are expanding money and debt. Gold to silver ratio helps reveal whether silver is cheap or expensive relative to gold. Volatility is high because silver is a small, illiquid market compared with major financial assets. Policy risk exists because rates and the dollar can pressure metals. Substitution risk exists because high prices encourage engineers to reduce silver use. This is the full picture. A serious investor does not only look at the bullish points. A serious investor looks at the full system. The full system says silver has a rare combination of monetary history, industrial necessity, structural deficits, constrained supply, and high volatility. That makes it powerful. It also makes it dangerous if misunderstood. Now, if someone buys silver because they think it will go up next week, that person may be disappointed. If someone buys silver as part of a broader wealth preservation strategy with proper sizing and patience, that is a different decision. The same asset can be speculation or insurance depending on how it is used. That is a principle across all investing. Gold can be speculation or insurance, oil can be speculation or hedge. Stocks can be investment or gamble. Real estate can be wealth building or over-leveraged risk. The asset is not the whole story. The structure, size, time horizon, and reason for ownership matter. For silver, the reason should be clear. You own it because you want exposure to hard money in a fiat world. You own it because industrial demand is structurally strong. You own it because supply is constrained. You own it because deficits are drawing down inventories. You own it because the dollar's purchasing power is not fixed. You own it because it diversifies away from purely paper assets. You do not own it because someone promised a straight line upward. There will be no straight line. Now, the final big picture is this. A dollar used to be silver. Then silver was pushed out. Then gold was severed. Now money is trust at the same time. Silver is being consumed by the technologies that governments and corporations are forcing into the future. Solar electric vehicles, AI data centers, 5G semiconductors, medical devices, water systems, and the world has been running silver deficits year after year. That combination should not be ignored. It does not mean you must buy silver. It means you should understand silver because understanding silver helps you understand money. It helps you understand the difference between a promise and a physical asset. It helps you understand why governments prefer flexible money and why savers need protection. It helps you understand why the digital future still depends on physical materials. It helps you understand why supply chains matter. It helps you understand why a small, volatile market can move violently when demand and scarcity collide. Most people will not study this until after the move is obvious. That is how markets work. The lesson arrives late for most people because the early signals are boring, historical, or technical. A coinage act, a monetary ratio, a mining deficit, a solar panel input, a byproduct supply constraint, a warehouse drawdown, these things do not look dramatic until the price moves. But the serious investor studies the mechanism before the crowd studies the chart. That is the difference. So if you are going to think about silver, think clearly. It is not poor man's gold. It is not obsolete. It is not safe in the short term. It is not guaranteed. It is not a replacement for a full financial plan. It is a volatile hard asset with deep monetary history and growing industrial importance. It can protect. It can punish. It can preserve wealth over long periods. It can also drop enough to test your conviction. That is why understanding must come before ownership. If you understand the system, silver becomes more than a metal. It becomes a signal that fiat money is not the same as hard money, a signal that technology is not weightless, a signal that supply cannot always respond to demand, a signal that the monetary past may still matter in the industrial future, and a signal that the dollar in your wallet is no longer what it once was. That is why silver matters, not to you, because the system is changing. And in a changing system, the people who understand the foundation of money have an advantage over the people who only understand the number printed on the bill.